On March 15, 2023, in New York City, a notable incident began to unfold that would have far-reaching implications across the nation's financial landscape. The main actor in this unfolding drama was FinTech Innovations Incorporated, a major player in the financial technology sector, celebrated for its cutting-edge payment processing and banking software solutions. On this day, the company released a routine software update intended to enhance its transaction processing speed and improve user experience. However, the update contained a critical flaw that would soon precipitate a cascade of failures. The new software was designed to streamline transactions by implementing an updated algorithm for processing payment data. Unfortunately, the algorithm was incompatible with the legacy backend systems still in use at numerous financial institutions. These institutions had delayed necessary updates for years, relying on their existing systems to handle everyday transactions. This dependency on outdated technology created a perfect storm for the difficulties that were to follow. The first technical failure occurred within hours of the software update's deployment. A misconfiguration in the new algorithm meant that transaction requests were being routed incorrectly. Specifically, data packets were not adhering to the legacy system's expected formats, causing them to be rejected, or, in some cases, processed with erroneous information. This issue was exacerbated by a lack of robust logging mechanisms. Critical logs that could have provided insights into transaction errors were either misconfigured or completely absent. The lack of real-time monitoring on the new update led to a significant process gap that would not be addressed until it was too late. By noon on March 15th, financial institutions began to experience a measurable impact. Preliminary data indicated that approximately 45,000 transactions had been either declined or misprocessed, affecting more than 12,000 users across various banks. The total estimated monetary loss from these erroneous transactions was projected to exceed $3 million in just the first hours. As the update rolled out to additional clients, the situation worsened. Reports of failed transactions quickly climbed to 90,000 by the end of the day, with estimated losses rising to over $6 million. Clients experienced disrupted access to funds, failed bill payments, and confusion regarding the statuses of their transactions. Internally, FinTech Innovations responded to the emerging crisis with confusion and miscommunication. An incident channel was created to address the escalating issues, but early reports focused on the new update itself rather than examining underlying dependencies on outdated systems. Internal emails circulated featuring assumptions that user errors were contributing to the problems rather than acknowledging the potential flaws in the software release. As employees grappled with the situation, patchwork fixes began to be discussed, but were hampered by unclear responsibilities and an inadequate understanding of the technical intricacies involved. Externally, users began to flood social media platforms and customer service lines with complaints. The influx of reports highlighted failed payments and missing balances, prompting monitoring systems to issue alerts. A minor backlash took shape in online forums, with users expressing frustration and concern over the reliability of their banks. Initial media mentions were cautious but soon charted the growing problem, speculating about the implications of software glitches in the financial sector. As the day progressed, the interdependencies among various banks and financial networks manifested as more institutions began to report similar issues. Alarmed by the rising tide of failures, some banks attempted to halt the processing of transactions using fintech innovations software, further revealing the widespread chaos. This reaction unpredictably intensified the number of afflicted users, as transactions that were captured by the software were now being systematically reverted or rescinded. By the end of March 15th, the cascade of errors had become undeniable. Reports from the financial institutions indicated that systems across the board were unstable, and suspicions about the update's role grew stronger. Various banks began conducting their own audits to pinpoint where the failures originated, leading to mounting internal pressures within fintech innovations to respond with a coherent strategy. The backdrop of increasing concern was tinged with a sense of urgency to rectify the failures as more users reported discrepancies. With potential financial crises lurking just below the surface, an incoming wave of investigative scrutiny was inevitable. Stakeholders from various sectors of the financial industry watched closely, anticipating how the situation would unfold. To further complicate matters, on March 16, 2023, as the chaos continued, several of FinTech Innovations' banking clients reported massive spikes in unauthorized access attempts to user accounts. This was alarming, as it suggested that potential hackers could exploit the uncertainty ushered in by the software failure. What began as a failure of a software update was now fanned by security vulnerabilities that threatened to sabotage the organization's reputation and trustworthiness. As the organization grappled with the fallout, responses became fragmented and responses more reactive than proactive. The looming comprehension that a critical correction was required weighed heavily on the team at FinTech Innovations. Yet, there was no consensus on what immediate actions should be taken to restore system stability across the networks laid bare by the update's inherent failures. The failure was not simply a matter of operational oversight. It was rapidly evolving into a crisis that posed an existential threat to the financial ecosystem as a whole, triggering the dawning realization that swift corrective measures were desperately needed. The gathering storm over the horizon suggested the intricacies of the issue were only beginning to unravel, and the repercussions would soon intersect with the broader economic landscape in unforeseen ways. As FinTech Innovations focused on damage control, a sense of urgency escalated within the financial sectors. However, the underlying risks associated with interdependent technologies had not been fully grasped, setting the stage for even greater challenges ahead. On March 17, 2023, as discontent grew, FinTech Innovations hosted an emergency meeting with banking executives to provide clarification on the situation. Unfortunately, the meeting devolved into confusion, and miscommunication persisted, leaving many attendees uncertain about what corrective actions were being taken. As the gap between expectations and reality widened, some banks began contemplating legal action against FinTech Innovations for their inability to ensure system stability. By March 18th, the impact of the update was irrefutable. Over 30 million users reported issues, leading to losses estimated at over $2 billion across several institutions. Financial transactions were stalled, and many businesses faced significant operational disruptions as payrolls and payments went unprocessed. The dense web of interdependencies meant that issues once localized within individual banks now radiated outward, triggering widespread outages and illiquidity among other financial players. As banks sought to regain control, several deployed emergency incident response teams. They began isolating systems, taking preventive measures to mitigate vulnerabilities, and enhancing security protocols for user accounts. Meanwhile, the fallout from the unauthorized access attempts resulted in immediate account bans for millions of users considered at high risk. The financial regulators intervened to assess the damages and mandated audits across multiple institutions reliant on fintech innovations technology. On March 20th, law enforcement was alerted as suspicious activity levels spiked, with numerous reports of fraudulent transactions surfacing simultaneously. Investigators uncovered potential links to organized crime exploiting the chaos, encouraging banks to further tighten user account security and reassess their reliance on third-party providers. The Foundation for Financial Technologies activated its fraud alert systems to reduce risks associated with compromised customer data, effectively initiating a sector-wide review of cybersecurity practices. As investigations deepened, internal chat logs from FinTech Innovations were leaked to reporters on March 22nd, revealing earlier discussions where warnings about the update's compatibility with existing systems were dismissed as hyperbolic. These revelations stoked public outrage and drew intense scrutiny from media outlets, which began publishing articles analyzing the ramifications of the incident on consumer trust in the financial sector. Analysts highlighted how legacy systems compounded the crisis, questioning the preparedness of financial institutions to modernize their technology infrastructure. By the end of March, the repercussions continued to unfold. FinTech Innovations announced layoffs to cut costs as subscriptions from client banks decreased and legal defense costs escalated. Several high-profile resignations followed in both FinTech Innovations and the banking sector, as key leaders stepped down, acknowledging the failures that triggered the crisis. By April, some smaller banks declared bankruptcy due to their inability to recover from the losses incurred during the outage period. In July 2023, a structured settlement was reached between FinTech Innovations and a consortium of affected banks, amounting to $500 million to cover losses and damages incurred. Compliance audits were mandated to ensure the integrity of the system moving forward, pushing the sector toward more stringent regulations around software updates and cybersecurity measures. While the immediate chaos subsided, the long-term effects loomed large. By the end of October 2023, the financial landscape had been irrevocably altered. Despite emergency changes and audits aimed at preventing such a failure from recurring, the crisis catalyzed sweeping reforms across the industry regarding technology dependencies and risk management strategies. Many financial institutions faced decreased market confidence, leading to reduced valuations and tightening credit conditions. Trust plummeted, limiting partnerships and risking long-term repercussions. In summary, the cascading failure triggered by the software update signified not merely an operational breakdown, but an illustrated case of systemic vulnerability within the financial technology ecosystem, which ultimately resulted in a pressing demand for re-evaluation of existing systems. Though FinTech Innovations survived the financial hit, its standing in the industry was permanently tarnished, leading to a significant restructuring of operations and a commitment to long-term transformation. Final update. As of October 30th, 2023, FinTech Innovations restructured and emerged from the crisis but faced ongoing reputational damage, with its market share significantly reduced and increased regulatory scrutiny on software practices within the financial sector.